Most investors build portfolios on hope, but there's a smarter way professionals approach the market. Hoping tech keeps rising, and last year's winners keep winning. That's how most retail investors make decisions. Hope-based portfolios rely on speculation, while rotation-based portfolios follow a disciplined professional strategy. Rotation is the single principle that separates sophisticated investors from those chasing trends. Let's explore how to build a rotation-based portfolio specifically designed for 2025. Welcome to Money Mastery, your step-by-step guide to financial freedom and building real wealth. This video shows how smart money structures portfolios without predictions, hype, or constant trading. The goal is simple: stay aligned with the market all year long. This isn't about beating the market every week. It's about consistent alignment throughout the entire year. Markets in 2025 demand a rotation-based approach because static strategies can't keep up with shifting leadership. We're moving away from AI hype, rate uncertainty, and concentrated leadership into a phase where dominance changes quietly and often. Static portfolios struggle in dynamic markets. They can't adapt when conditions shift. So what exactly is a rotation-based portfolio, and what does it really mean? It's built on 3 pillars: flexible allocation, awareness of which sectors are leading, and adjusting exposure without letting emotions take over. You're not chasing trends, you're responding to strength as it emerges. A professional rotation portfolio has 3 distinct layers working together. The first layer is core stability, broad market exposure through high-quality assets that keep stress low and participation steady. The second layer is where rotation actually happens. The opportunity engine. This is where you tilt between value and growth, defensive and cyclical, or large caps and small caps. The third layer is tactical cash, and it's more powerful than most people realize. Cash lets you buy during fear, avoid drawdowns, and increase flexibility when opportunities appear. Smart money doesn't predict 2025. They start neutral and observe what unfolds. Early positioning means reducing concentration, balancing growth and value, watching defensive strength, and respecting bonds and yield. The goal is readiness, not certainty. You don't rotate constantly, you follow a disciplined rhythm. Review monthly, adjust quarterly, and react only when leadership change is confirmed. When a sector shows sustained strength, you slowly increase exposure. When leadership fades, you scale down methodically, no panic selling. Real rotation is triggered by behavior, not opinions or headlines. Watch for relative strength over weeks, resilience during pullbacks, volume supporting price, index divergence, and bond market confirmation. One signal is noise, multiple signals are information. A rotation-based portfolio fails when you make these critical mistakes. Chasing last week's winners, rotating too often, ignoring risk, falling for themes, and trading headlines all lead to failure. Rotation rewards discipline, not excitement. Where do you think leadership shifts first in 2025? Will it be value, defensive sectors, small caps, bonds, or will AI continue leading? The biggest edge professionals have isn't what you'd expect. Amateur investors try to be right, professionals try to be aligned. Alignment beats prediction. Let's lock in the key takeaways. Markets rotate, leadership changes quietly, portfolios must adapt, cash is a position, and discipline wins. A rotation-based portfolio keeps you alive and compounding. That's the real goal. If this video brought you clarity for 2025, let's keep that momentum going. Subscribe to Money Mastery for your step-by-step guide to financial freedom and wealth creation. Next up, we'll tackle how to manage risk when markets throw you a curveball. When market surprises hit, they ripple through your risk management, investment strategy, and portfolio protection. Thank you for watching, and we'll see you in the next video.